Hey guys, this is Tim and Jess at the Real Financial Group. Just wanted to do a video really looking at portfolio management.
And the effects that interest rates have on it. So, as we go into this very volatile market, there's a couple things that we want to make sure we point out. A lot of clients get confused when we tell them stick with the plan, stick with the strategy, and that is true. So it is our job when markets are doing well to capture as much of that return as we can for you, and then protect you on the downside. But once the market has dropped, right, and we come into a time now like we do now where you have a lot of volatility.
Hmm.
There's some things to keep in mind. Is staying invested doesn't necessarily always mean staying invested in the same things that you were.
It's a sports analogy. It's like thinking, you're going to use the same playbook even though
Correct.
it's not getting you any wins.
That's a very
So
good.
what we do is reevaluate the playbook.
Absolutely, absolutely. So to give you an example, we'll use apples. Apples for apples. It's Earth Day. I needed something that would make Tim blush. He was really worried about what I was going to do with these. But so let's say you own two mutual funds inside of your 401k. You own $100 of each of them. One's oil, one is retail, and so they've dropped now to $50. So as we look at the forecast for economic growth, and we say, what do we expect? Well, we expect this oil fund to return back to its value much quicker than the retail fund. And this is just an example. So instead of keeping both and having this one go back to 100 and this one go to 75, taking that money that's in the retail fund and reallocating it into an oil fund that's going to rebound much quicker makes more sense than having that offset that you would have by just allowing it to naturally happen. And so those are the types of things that to look at. Again, we're not day traders. It's not what we do here. We're long-term investment strategists, and so it's really just making some little minor adjustments. And a good example of that is conservative portfolios. So in a conservative portfolio, it's bonds, fixed income, we call them. You own debt of a company, and so if you over the last decade, conservative portfolios have actually netted a negative return, and this is why. When you have historic low interest rates, you know that interest rates can only go up, right? And that's great if you're looking at a savings account, but if you're looking at a conservative portfolio and you have bonds, so and this isn't just bond funds,
Hmm.
right? This also applies to target date funds. So target date funds are 2020, 2025. It depends on they target the year you're going to retire. They start with when you're young.
Hmm.
You have mostly equities, and your fixed income is much lower. And as you get older, closer to that year on the target date, they readjust to have mostly fixed income or bonds. And in this case, that can be somewhat detrimental as interest rates will begin to climb at some point in the future. So normally, under normal circumstances, interest rates just fluctuate. They go up, they go down. But we know that they're at historical lows again and will go up. So to show you how this works is, let's say I bought this bond and it pays us 3%. So if you keep it for 10 years, it's going to pay you 3%. Let's say you spend $1,000 on it. At the end of the 10 years, you're going to get your $1,000 back after receiving those payments. But if interest rates go up to 4%, your bond, although if you hold it to maturity, it will still be worth $1,000 at the end. But that's not how funds work. And in 401ks especially, you do not own individual bonds. You own a fund.
Hmm.
They're required to book mark-to-market values on a daily basis. So if you have this bond paying 3% and interest rates go to 4%, no one's going to pay you $1,000 for this bond that only pays 3% payment, because they can take their $1,000 and buy this 4% bond, which means your bond value drops to $900. In this case, we'll say a $1,000 bond. So now your portfolio has dropped in value. So as interest rates climb, your bond or conservative portfolios lose value. It works the other way around. If interest rates are high and then you own this 4% bond that you paid $1,000 for, and interest rates drop to 3%, your bond is now worth more because, well, my new $1,000 can only buy a 3% bond, so I will pay you more to get a 4% rate of return. This is an anomaly. It's something that it always exists, but right now it's incredibly relevant to portfolio management. Speak with your advisor. Make sure that you've come up with a strategy, sticking with what you had isn't always the best option for you. A lot of times, just making some minor adjustments inside your portfolio to capture return, and looking at more than just interest rates and market volatility, but consumer sentiment, retail areas, with oil futures at a negative net $37 a barrel. There's some really interesting opportunities out there for you. So talk with your advisor. We remind you, try and work with a certified financial planner if at all possible, a CFP, which we'll get into another video, offer a fiduciary responsibility to their clients. I wanted to take a few seconds. Can I?
Yeah, go ahead.
So Tim, in these last couple of videos, hasn't said a ton because I talk too much. That's all right.
He's got more letters after his name.
Yes. Tim handles all of our financial consulting and coaching. He teaches our Dave Ramsey courses. He adds an incredible amount of value to the firm, and so we're going to start breaking these videos up into topics, very specific topics. With social distancing, Tim, myself, and Janessa are the only ones that are in here in the mornings. Everybody else has either decided to social distance or been told to social distance. So we will introduce you to the rest of the team as the months progress here, and we're able to all get back to work and work within a safe distance of one another. There's some fun topics, so I want to come up. So if you're watching these videos, we have the Professional Referral Network is a group of professionals we put together about 10 years ago. We have a Zoom meeting tomorrow morning to decide what local charity we're going to support during these times. And on Friday, I'll do a video introducing you to the PRN group and the charity that we're going to support. And then on Monday, we are going to do a really neat video on the opportunities that exist for you as individuals coming out of this turmoil. Right? So, if you've lost your job, if you're there, instead of worrying about it, try to capture the opportunity. We're a very business oriented firm here. And then on Wednesday we'll do super 401ks. If you're an established business, this is one you definitely want to watch. It's not what you think when it comes to just 401k planning. It's a pretty amazing opportunity for you to stick a significant amount of money away for yourself in the final years of your business, and add value for the sale at a very low cost, employee cost. So with that said, you guys have a great week. We'll see you in a couple days.
See ya.